Hello and welcome back to All Things Money. I'm your host, David Blain. During the second segment of today's show, we're going to continue talking about what makes a good investor, and we're going to tie it together with a specific example of today. So we talked about how a good investor is somebody that focuses as much on how not to lose money as make money. And by that, I don't mean burying your money in the backyard or putting it in a mattress or some fearful, scared of your own shadow type thing. I'm talking about looking at a way to invest that acknowledges the fact that there's risk in the marketplace, and you don't just make money by happenstance, or just because you invest in something doesn't necessarily mean you're going to make money. It means investing and looking at a holistic point of view where you acknowledge risk. And a couple of things we talked about that prevent people from doing that: they're overconfident. You see it on TV every day. Oh, the S&P 500 is going to do this, or inflation is going to do that, or unemployment's going to do that. Let me tell you, they have no idea that if somebody had the ability to predict that sort of thing. I mean, look at the elections. How many people predicting different results, not just the presidential, but all the way down to the congressional level. It's just not an exact science. Statistics, social sciences, investing, it's not like, we've talked about this before, it's not like the law of physics. If I drop this pencil, the law of gravity says it's going to hit the table. Investing is not the same thing. You can't say this, is this for sure. What we do have are some basic principles of diversification and valuation and things like that, and that's what we're talking about here, to make sure that people don't become overconfident and we look for ways to lose money. And a way to lose money is to think that you know the answer. And we see a lot of hindsight bias. Hindsight bias is where someone looks back and they say, oh yeah, I knew that. I knew that the market was going to crash in 2008. And so they sit here today with their portfolio and they say, oh, well, I know it's going to crash. So that hindsight bias combined with the overconfidence makes people make extremely poor decisions. And a lot of what a professional like myself does on a regular basis is combat those biases. It's not necessarily the numbers, it's combating those biases by building diversified portfolios, having investment policy statements that are written, your plan of action ahead of time. This is the way I'm going to invest, and until my situation changes or my capacity to assume risk or my goals or something, this is how I'm going to invest. And it helps prevent some of those disastrous mistakes. And so knowing how you react to these market forces and combating these biases and paying attention to the risk of something and focusing on how not to lose money as much as making money will make you a better investor. And that brings us to something that is currently going on. Risk in investing is unavoidable. There are different types of risk. Putting your money in a safe CD at the bank has risk, namely purchasing power risk, inflation risk. It may not be subject to loss of your money per se, but there are risks involved. And today what we see is some of the mistakes that people are repeating, taking on significant amount of credit risk, duration risk, and leverage in the bond market to get higher yields. So a lot of investors look historically to the safety of bonds for income. Let's face it, someone that retired in the early 1980s and was getting 10 to 15% interest on U.S. Treasuries, looking at today a 10-year Treasury yielding 1.7% is not that exciting. And so what we've seen since the market bottom in 2009 is we've seen about $900 billion flowing into bond mutual funds, while stock flows have seen net outflows of $200 billion. So all the cash that people pulled out during the recession, they've been flooding into the bond market. During that same period, since March of 2009, the S&P 500, or stocks, returned 123.8%, including dividends, while the 10-year Treasury has earned a relatively meager 22.5%. And so once again, we see investors doing the exact opposite of what they should be, that they're completely off cycle when they should have been buying stocks in March of 2009 when things looked the worst and the world was coming to an end. That's the time to purchase. Instead, they've been purchasing bonds that are at historically low yields. Now, this is something that is interesting. If you're buying a treasury bond today to replicate the performance of the past few years where they've returned 20-some%, bond yields would have to go negative. You would have to have a negative yield on the 10-year treasury over the next 10 years to earn what you have the previous 10 years. I hope that makes sense to you. The return of a treasury is fairly easy to estimate as you look at the current yield. So if the current yield on the 10-year treasury is 1.7, guess what? 10 years from now, your return will be 1.7%. And so in order to duplicate the returns of the past 10 years in the bond market, treasury yields would have to be negative, which is just not going to happen. And so it mystifies me why people are flooding into the bond market, even accelerating the pace of flooding into the bond market. There's a tremendous amount of risk in the bond market right now. Now, one explanation is, people are more risk averse now. They got spooked, the 2000 bear market, the 2008 bear market, and so they're just very risk averse right now. Well, we think there's some other explanations for this, but we're coming up on our second break. So when we come back, we'll continue talking about some mistakes that investors are making in the fixed income market today. So for All Things Money, I'm your host, David Blain.